Obviously, we're putting out this commentary in a period in which the Irish economy is expected to grow very, very strongly for the present year and into next year. This is due to a confluence of factors. The position in which we are at present in terms of the lightening of the public health restrictions and the reopening of the economy and society, as well as very, very strong performance of the traded sector, in particular the export sector. And all of this is kind of culminating in a very, very high expected growth rate for 2021 of double-digit growth. So 11.1% is our headline growth figure for this year. Obviously, as I said, the main driver of this double-digit growth has been the exceptional performance of the traded sector. We see huge export growth in the first quarter of this year. It's up 17% year on year to the first quarter. And this is on the back of some quite strong rebounds last year following the quarter two first lockdown period, where there was a global slowdown in the traded performance. So really, when we are talking about the exceptional double-digit performance of the Irish economy, this is very much to do with the strong performance of the export channel. That notwithstanding, we do expect quite a strong rebound in the domestic economy, in particular domestic demand. We're expecting consumption and investment to grow strongly for the year. Our kind of baseline forecasts are built on the premise that there will be a continued easing of the public health restrictions for the rest of the year, and that they will be able to be permanently set at a lower base, for example, with no repeated stringent lockdowns going forward. We also expect that the vaccine program will continue to be rolled out in line with the current schedule, and that the current vaccines continue to be efficacious in that context, so that the expected reduction of public health guideline restrictions as the vaccines are rolled out can continue into this year. If that is the case, then we expect consumption to rebound very, very strongly, 7.5% growth in consumption this year relative to last year, and investment we also expect to kick back in. That notwithstanding, the fact that there has been a very strong growth rate this year, and the fact that we did grow last year in the middle of the pandemic, which was an outlier in terms of the international experience, there has been a cost to the economy of COVID, and there's a box in the commentary which quantifies relative to what the position was before COVID, what that impact would be, and it's estimated to be about 24 billion euros, and Kieran will talk a little bit more detail about that. So as I've said, in line with the continued easing of the public health restrictions, we do expect the unemployment rate to adjust downwards. Obviously, we expect it to adjust downwards quite dramatically over the coming months as sectors are reopened. So, for example, you'll get a very large reduction as particular sectors go back to work, and we see the unemployment rate coming down to just under to 9% at the end of this year. And as I said, this leads us to an overall GDP growth forecast for 2021 of 11%, and again, strong growth next year. Some of the momentum will carry through. We see 7%, just under 7% growth for next year. So just to provide the summary table, as I mentioned, last year we were the growth performance that we had was quite exceptional in an international context to actually post GDP growth last year. And that obviously provides a contrast between the domestic economy. You can see the consumption fell very strongly last year. Investment also fell back, but the export channel really drove the growth rate last year. And obviously the public spending kicked in when the private sector pulled out of the economy last year. So that was a natural stimulus to economic activity. For this year, we as I've said, we expect a continued strong consumption growth. We expect continued strong public spending. We see a rebound in investment as firms become more certain around the context and the business environment, and also as the housing market begins to to recover from the restrictions in the first quarter of this year. Then obviously the real growth that we see is coming through the export channels. It's 13% export growth, which is really, really strong, leading to an overall GDP figure of 11%. As I mentioned, we expect the unemployment rate to tail down quite dramatically at the end of the year, but obviously because we've had elevated unemployment rates for the first half of the year, the average for the full year we expect to be about 16%, but that will come down strongly with the recovery towards the end of the year. In terms of the public finances, we see large deficit this year, a little bit less than last year, of just over 17 billion. General government balance about 4.5%, 4.1% of GDP deficit. So that's an improvement on last year. In terms of next year, consumption we see picking up again as households wind down some of the savings balances that they've built up and they re-engage with the activity as that they have been denied over the period of the public health restrictions, and then some reduction in the growth rate of public spending. Investment again strong and trade strong next year, leaving a GDP growth of just under 7%. So very, very strong performance for next year as well. This chart provides the decomposition of GDP growth into the components. So which of each of the components adds contractionary or stimulatory effects to the overall GDP growth rate. And what you can see for 2021 is that the export channel is really providing a positive increase to growth, but also the consumption and the investment have turned into the positive territory, which is important. In terms of consumption, it's important to think about a little bit more detail, because we did have those restrictions applying for the first quarter of this year, and that was seen quite markedly in the national accounts. First, the consumption was down 11% year on year in the first quarter of 2021, as the range of measures were applied to economic and social life, restricting the consumption bundle for Irish households relative to other countries. This can be seen pretty clearly in the chart here, which shows the annualized consumption growth rate for Ireland, which is the little purple dashed line, relative to a basket of other European countries for which data is available through Eurostat. And then you can see the mean growth rate for the countries is the dark blue line, and the median is the dashed light blue line. And you can see, while the consumption shock in Ireland in the second and third quarters of last year was similar to the European countries, the fall in consumption in the first quarter of this year was larger than in other European countries, which is likely linked to the degree of the length of period of the lockdown, the severity to which the public health restrictions were applied across sectors, and the severity of the infection outbreak that we had in the first period of this year. So you can see quite a large drop in an international context, or certainly European context, for Ireland in the first quarter of this year. That notwithstanding, we do see the rebound being quite strong. You can even see it in some of the early leading indicators we have, such as the retail sales. As businesses have been able to reopen, there has been a kickback in terms of the expenditure of households, and we kind of see that as continuing through this year as the vaccines are rolled out, as the public health restrictions can be loosened, and we feel that one of the elements that we will see is that households will channel that expenditure, because they've been building up very large savings balances over the previous 12 months, that they will channel that expenditure into the types of goods and services that they haven't been able to engage with over the period of public health restrictions, and that should allow some of the rebound to channel into those affected sectors, facilitating their recovery to an extent. But it will be broad-based as well. It will filter down through all expenditure items. In terms of investment, we see there was obviously a big drop last year, which is related to some of the multinational activity. But there was a domestic investment fall last year. You can see building construction activity was rebounded towards the end of the year, but then has fallen back in the first quarter of this year as the construction sector had to be covered by the public health guidelines for infection management reasons. For this year, we do expect investment to rebound. We see construction in particular from the second quarter onwards acting as quite a stimulatory factor to that growth activity, and this should lead to a sustained recovery and investment. And in more generally, as firms become more certain about what the operating environment will be, and if the vaccine rollout continues and it continues to be efficacious and public health measures are reduced in line with the current rollout plan, then businesses should have a better understanding of what their operating outlook will be going forward. To just give a little bit more detail on the housing market, we're expecting about 18,000 completions this year. This is up on our expected 2021 outturn from the first quarter of this year, and that's because we've seen the rebound being able to take place with the removal of restrictions in the sector. We expect it to continue to grow through the rest of the year. Then for 2021, we expect about 21,000 housing completions, so continued growth overall. I think one of the elements of the rebound in construction that we have been watching quite closely is the trends in commencements, because obviously commencements are a good leading indicator for completions with a time lag of anywhere between 8 and 12 months. So what we can actually see is for the first period of this year for which we had actual data, there was quite a marked reduction in commencements, as that would be expected, but it was large even relative to the first lockdown period in April and May of last year. So this obviously being the forward path for completions will need quite a bump to get back to levels that we see in the pre-pandemic period. So certainly we can see the effects of the pandemic feeding through into the commencements activity. So to talk just a little bit more about the trade activity, this is really where we're seeing the very, very strong growth coming through for the Irish economy. 2020 was a year of really strong export growth, given the context and given the Q2 global slowdown in international trade. And again, when we always talk about the export channel, we really are talking about the exceptional performance of very specific subsectors. And here we're talking about medicinal and pharmaceutical products and computer services. These are such large export value sectors for Ireland, and these are the ones that are performing exceptionally strongly and driving forward the overall level of export growth. And this is leading us really to have such a strong traded performance. We do expect imports to rebound this year. We do see this rebound to come in line with consumption. Obviously, with the consumption increase, we'll get an importation effect, and also as part of the export activity. But obviously, the value of exports being much larger than the value of imports allows this increase in the net trade to kick through to the growth channel. Yeah, this slide just shows again the high concentration of the value of exports, service exports and merchandise exports in these two particular subsectors, computer services and medicinal pharmaceutical products, which are the areas which are currently driving growth in the Irish economy. You can see quite clearly, if you can compare the lightest bar, which is the light kind of greenish bar, which is the first quarter of 2021, with the dark blue bar, which is the first quarter of 2020, you can see considerable growth in both of these sectors on a year-on-year basis. Obviously, another contextual element for the change in our economic activity has been the ending of the transition period and the starting of the new trading arrangements between the UK and the EU. Obviously, this is having a disruptive effect on trading activity between Ireland and the UK. You can see that quite clearly in the trade data. The value of goods imports from Great Britain declined year on year in the first quarter of this year quite strongly, but exports didn't decline to such an extent. And obviously, there's asymmetries currently in the degree to which the customs checks are being applied on both sides of the relationship, which is leading to this. And one of the counterbalances to that we have seen is been a pickup in activity with north-south trade in the first quarter of this year, with both goods exports and imports increasing quite strongly. So something obviously to keep watch on, in particular for particular sectors. So at this point, I'm going to hand over to Kieran. He's going to talk through the labour market. I'm going to just stop sharing the screen and let Kieran take over.
Thanks very much, Conor. And good morning to everybody. Okay, so just on the labour market side, so therefore, as Conor outlined at the start, whilst we have this, very, very significant growth rate this year and strong growth next year, obviously we do still see very elevated levels of unemployment. And again, just to recap, our unemployment definition, as we're using it here, is for people on the live register and the pandemic payments. It's not inclusive of those on the EWSS payments, for example. So it reached a peak in the present year at 25% unemployment in Q1, down to just over 22% in April of 2021. And as of the last week in May, there was still just less than 310,000 people claiming the pandemic payment. We present some details in the commentary on the breakdown of the pandemic payments, and you will have seen this in previous commentaries and in other work by colleagues of ours in the Institute. Highlighting the fact that I suppose 25%, 26% of all PUP recipients were under 25 years of age, and 22% were between 25 and 34. So very much concentrated in the younger age groups, and also in terms of the sectors of the population or sectors of the economy that are in receipt of the PUP. So the majority in the accommodation, food, retail, trade, and the construction sector. So despite the very high growth rates, which, as Conor said, is in large part down to the export and traded sector performance, so obviously still the rebound coming from the domestic sources, but overall our average unemployment rate for the year is 16.3%. Within that, you have the peak in the first quarter of 25%, coming down to just under 10% then for the end of Q4. And next year, we expect to see the unemployment rate coming down, I think, by the end of the year to just over 6%. So, we would have revised down our unemployment forecasts, if you like, or had a stronger fall in unemployment compared to the previous years, mainly because of the strong performance, the better than expected performance in terms of the economy. So in terms of the unemployment rate, you would have seen this before, I suppose, just highlighting the recovery in the Irish unemployment rate after the financial crisis, and then the very sharp peak. So you can see that the actual unemployment rate during the pandemic reached a peak, I think, in May of 2020, when it was actually over 30%. So obviously it fell through the remaining part of last year as the restrictions were eased, and then obviously we saw the increase again in the early part of this year when you had the fairly significant restrictions imposed at the end of 2020 and start of 2021. And so again, you're beginning to see the fall off in the rate as the restrictions are eased. And to a certain extent, we've been drawing off the kind of the dynamics in the labour market from last year when the restrictions were eased in terms of our forecast for the present year and into next year. Again, some more figures that you will have seen us present before, which is the week-by-week account of those on both the PUP and the live register. The live register, of course, being the traditional unemployment rate or traditional unemployment assistance. So you can see again, in May of 2020, it reached a peak in terms of the PUP of over 605,000 people on it that particular week. Declined then significantly throughout the latter part of 2020, and then obviously reached a peak again in January, the week of January the 24th of the present year, when you had it at 484,000, and then it's been declining to the 309,000 that it was at the end of May. So again, you can see the volatility, I suppose, there in terms of the numbers on the PUP, and obviously very highly correlated with the public health and easing of the public health and imposition of the public health restrictions. In terms of the public finances, as Conor pointed out, Obviously, very significant deficits both this year and last year in response to the crisis, and of course that's mainly coming from the pandemic payments, the subsidy scheme payments, and also obviously the additional expenditure in health associated with the pandemic. This year, our deficit will be at around just over 4%, the general government balance definition, so 4.1%. That's a little bit less than what the Department of Finance are saying, for instance, in the Stability Programme update released in April. The reason being is that we're not allocating all, there was some contingency funding in the Stability Programme update for the pandemic. We don't believe that all of that contingency funding will be drawn down now, particularly, I suppose, given the rate of pace of the recovery that we expect in the economy. Next year, you can see that we expect the deficit to come down further, so around just 8.7 billion, which translates into just under 2% of GDP. I suppose what's interesting as well is because of the very significant recovery in GDP, you can see that the debt to GDP ratio is down to 55.8% in the present year and then falling further to 53.5%. In the commentary itself, actually, we present, when we're presenting the graph on the debt to GDP, we actually stretch it back to 2005, 2006. So you can see the changes in the debt to GDP ratio due to the pandemic and compare them with the financial crisis. And you can see that really it's only a very modest, in the present context, the debt to GDP ratio has only increased very modestly compared to what happened, of course, back in 2009, 2010. In terms of the tax receipts so far this year, we've seen quite strong performance in income tax, VAT. Corporation taxes are down, but again, it's you probably have to wait till the June, July, and November figures before you can kind of definitively say what's going to happen in corporation taxes. Overall, we expect taxes to grow by around 10% in the present year. That reflects the recovery, particularly in the domestic sources of growth and consumption and investment. You know, so there's strong recovery, strong pickup in income taxes or taxes generally, but expenditure is still set to remain quite elevated because, of course, of the relatively high numbers of people on the pandemic payments in particular. So overall, that results in the deficit then of 17.3 billion and just over 4% for the present year. In terms of there's a couple of boxes in the commentary. This box we just wanted to draw out a little bit. So you may have seen the paper that we released on housing and finance there 2 weeks ago, which talked about the possibility of doubling, for instance, government expenditure on the capital side of housing as a way of addressing the shortfall in supply. There was also quite a bit in there on the financing of that, and which maybe didn't get quite as much attention. So we've drawn that out in a box. Basically, what we do is we take kind of well-known kind of debt ratios, if you like, to work out how much, money effectively we could borrow as a country year on year, given the pace of growth that we expect in the economy over the forthcoming period, and also given relatively lower cost of sovereign debt that is apparent. And you can work that out. You can specify a debt to GDP ratio. So for a given debt to GDP ratio, for example, of 45%, which we believe is quite conservative, and indeed the government itself has outlined that as a target, we can work out then, subject to the different growth rates of the economy and different borrowing costs, we can work out how much we feel the government could borrow on a sustainable basis, over the medium term. And so, for example, if we take a growth rate of, if we take R equaling 1, which is the sovereign debt cost, so if we take 1%, which is somewhat high compared to where they are at present, but nonetheless, we, as I said, we take more conservative assumptions just for the sake of the exercise. A borrowing cost of 1%, if the economy grows at, say, 4.5% in nominal terms, if you're targeting a debt to GDP ratio of 45%, that would allow you to run a deficit of around 1.5%, which would bring in, for example, 6 billion additional funds per annum. So again, just to stress that we're targeting a debt to GDP ratio of 45% in that particular scenario. We're allowing sovereign debt cost to be 1%, and we're saying that the nominal growth rate of the economy is going to average around 4.5%. And in that context, you could run a deficit of 1.5%, which would bring in 6 billion. And then you can see in the rest of the table where we take, for example, a higher debt to GDP ratio of 60%, and we vary the growth rate of the economy, and we take different sovereign debt costs, you can work out then the corresponding deficit which you could run. So I think just gives an idea and gives you some, if you like, distribution around what the government could possibly do in terms of from a borrowing perspective over the medium term. The other box which we have in there, which Conor referred to, is to try and quantify the cost in output terms, the economy of COVID-19. So what we do in the box is we take Cosmo, the large-scale econometric model, and we use Cosmo to forecast forward how we think the economy would have grown in the absence of COVID-19. So we generate growth rates from 2020, 21, and 22. And then we compare that with what actually happened in 2020. So what actually, what the national accounts state in 2020. And we also compare it with our forecasts, QEC forecasts for 2021 and 2022. And that allows us then, by comparing the two different lines, so the blue line in the graph there is the baseline, so that's the Cosmo forecast, if you like, that's the absence of COVID. And then the red line is what we've observed in 2020, and also then the QEC forecast for 2021 and 2022. When we compare the graph, so when we look at the area under the graph and quantify that for across both 2020 and 2021, so for both years, the overall cost in output terms is around 24 billion. Okay, so that's the area under the graph. That's across both 2020 and 2021. The output cost, when we combine it, is around 24 billion. And of course, the other thing to note from the graph is that by 2022, if you believe, taking the very strong growth rates, I suppose, that we're forecasting, we actually have the economy back to where it would have been in the absence of COVID by 2022. So that's quite a swift recovery, notwithstanding the fact that you have a significant output cost in terms of the output lost in 2020 and 2021. So then overall, the overall assessment, so the easing of public health restrictions and the strong performance of the export sector and strong increases in particularly private consumption all bring us to this very strong growth rate of 11%. Just to put it in context, if we take domestic demand, which of course is consumption, investment, and government consumption, that's up we were forecasting that to be around 6.4% in the present year, and then 7.3% in 2022. So, a large amount of that overall growth is coming from the export and traded sector, but we are still expecting quite a strong pickup in domestic sources of growth as well. The unemployment remains quite high, given the fact that even notwithstanding the very strong growth rates, we do expect it to decline to around 9% by the end of the year, and then to average 7% next year, and coming down to under 6%, I think, at the end of 2022. You have the output costs, which I just talked about there, around 24 billion. And then housing completions, which we talk quite a bit about, obviously, in the paper, forecast to be around 18,000 units. I suppose the paper makes the point that, given the shortfall between supply and demand, that we feel really the government, there's a pressing requirement for the government to increase its investment in housing as a way of addressing or trying to alleviate that difference, because of course the danger is that we will see continued house price inflation and even rental inflation in the years to come, as long as we have that imbalance. We think in terms of the box and the paper, we think there is the potential for government borrowing over the medium term under prudent and sustainable conditions. There are many, there are significant capital investment challenges out there. There's the whole issue of meeting our environmental targets. There's the potential, funding of sláinte care. So there's a lot of infrastructural challenges and requirements out there. And so, we think it's important that the government would look at all the potential revenues that it can in terms of funding some of the capital investment in these areas. And obviously housing is a very important part of that. Still quite early in terms of evaluating the impact of Brexit on the economy, but it is notable that we have had this very significant fall off in imports between Ireland and Great Britain for Q1. As Conor pointed out, that may be due to the asymmetries in the tariff arrangements, or in the monitoring of the trade relationships. But also it may be down to the fact that there may have been significant stockpiling at the end of last year by some, by Irish firms. And so that may have led to a fall off in imports in the present year. Obviously, the other big issue in terms of global tax reforms was the recent agreement at the G7 about the possibility of shifting the corporation tax rate to 15%. That will obviously pose challenges for the domestic economy, and particularly given the very strong increase in corporation tax receipts over the last number of years that I'm sure we've talked about with you in previous commentaries. So we think it is obviously the Department of Finance have been allowing for this. That's very prudent, I think, given the possibility of these reforms coming in. You know, obviously, you know, we'll follow developments, particularly as it moves towards the you know, the G22 and the OECD reforms as the year progresses. So with that, that's the end of the presentation.